The UK is certainly, some of the DNOs are seen as global leaders in innovation. But having said that, you've got a number of the different DNOs from around the world watching very closely as they're sort of unbundling some of these services, looking to provision cost-effective grid edge flags. Australia, I'll probably add, is someone else who's focused significantly on this. They're looking at various different configurations of our products to deliver a similar, quite different service.
Hello and welcome to Energy Unplugged by Aurora. This podcast features various experts from Aurora having in-depth conversations with key industry leaders, policymakers and academics from all over the world. It explores the hottest topics across the energy market and gives a unique perspective on major energy issues.
Welcome to Energy Unplugged. I'm John Feddersen, founder and chief executive of Aurora, and my guest on the show today is Paul Ezekiel. Paul is founder, chair, and chief investment officer of AMP. And for those that don't know, AMP is primarily a renewable energy developer, owner, and operator with a focus across solar, wind, and storage, and over 7 gigawatts of assets built or contracted since foundation. And I suppose unusually for a company that focuses on developing and owning renewable assets, a technology company. AMP-X is a part of the company whose products include a transformer to provide dynamic voltage regulation and VPP software, which operates, optimizes large numbers of small assets. Before AMP, Paul had a long history in the energy transition. He's been involved in clean energy for around 2 decades. And before this, he was a medical doctor with a training in neurosurgery. So welcome to the show, Paul.
Hey, John. Yeah, thanks for having us, man.
Yeah, no, thanks for joining. I know you're super busy. Let's start a little bit with history. So AMP started with solar back in 2009. Solar was a lot more expensive back then than it is now, and I think for most investors, it was a much higher cost per unit of energy technology than wind. What was it that made you choose to focus on solar in the early days?
Yeah, so John, yeah, it's a great question. When we started AMP, right, and I think it's probably useful to sort of just look at the background to AMP. We just didn't start this sort of de novo, ad hoc, and think solar was a smart investment play. This came from decades of sort of preceding work, and I was was running energy trading at the Credit Suisse, based here in New York, where we started building energy assets off the trading desk, and this goes back about 20 years. So originally it was some thermal, but then got into solar and wind. And was quite successful. We were then asked to build an infrastructure company, or infrastructure fund by the CEO at the time of Credit Suisse, which we began doing then became the financial crisis. So the thesis at Credit Suisse was to build a platform whereby you'd build and deliver large pools of risk for big institutional clients. So when we started AMP, when we spun out of Credit Suisse, I should say, to start AMP, the thesis was essentially the same as what we were looking to build there. So build a platform to build large pools of risk. And so, although you're right, there was certainly a cost differential on sort of delivered cost of energy. We also, at that point in time, this is 13 years ago, there were emerging pools of liquidity, specifically around feed-in tariffs. And there was a feed-in tariff being introduced by the Ontario government at that time, you probably remember, which was, it was a fairly attractive price point. So my partner, based in Ontario at the time, somewhat fortuitous perhaps, but that's where we sort of anchored the business and sort of focused on, some solar as relatively easy wins for literally a startup business. So it was really literally driven by the needs of the business to sort of have some quick wins, which was it was pretty easy to achieve in Ontario back then, rather than sort of the fundamental unit economics, which was obviously a subsidised market.
Yeah. Okay. Interesting. So it was just a government policy dictated the direction.
Purely
were you raising capital at the time? I suppose financing off the back of a FIT. Well, nowadays it would be one of the easiest things you could do in renewable development. Was it a relatively simple concept to convey to potential investors?
Yeah, no, really, really simple, right? I mean, feed-in tariffs have obviously been around a long time, and they were certainly not the first. Obviously, a great credit at the time, so really easy to finance. It was literally opportunistic for how we built the business and got going. I think we raised a few $1 million, sort of friends and family, but basically, with a couple of quick wins in this feed and tariff regime, basically that became the venture funding for the business, if you will. And then that enabled us to launch into multiple markets in which we operate.
Yeah. Okay. Interesting. Just one other thing on your career to date. So unusually, you're a medical doctor. You studied that way. Did it help? Has that training helped you at all in what you're doing, or yeah, from a how do you think about that? Or was it just a detour that was part of
slightly unusual to go from slightly unusual to go from neurosurgery to what I do now? Has it helped? Sleep deprivation and ongoing sleep deprivation, working in markets around the world has been great training, right? But, I mean, obviously, it's fundamentally different training. But it was obviously a fun career. But went to business school, which was obviously the left hand turn in the career. But Neuro was brilliant.
It's kind of one of my lament. I don't know if it's a lament about Australia, but Australia is a country where a lot of the best and brightest into medicine, which is, I'm sure, a wonderful calling, but it also, I suspect it's the loss of other non-medical fields that there's such a concentration of talent in Australia in the medical profession for some reason that I don't know. Can we talk a bit about AMP's strategy? One thing that strikes me, I mean, there's the technology piece, but the other thing is you're pretty geographically spread, right? And you're not, and when I say it's not just geographic within, say, OECD. You're in Japan, you're in India, you're in the US, you're in Spain, you're in Canada, various other things, I think Middle East as well. You haven't specialized in, for a developer, an asset operator that's been around for under 2 decades, you haven't decided to specialize in one or two markets. I suppose why, and then the implicit question in that as well is, how do you offset some of the diseconomies of scale that come with operating in multiple cultures, time zones, market arrangements, those types of things?
Yeah, look, it's a really good question, and I think it's certainly one of the ways we differentiate, right? Is we are completely different from most developers who are sort of what we view as one-trick ponies, right? So where you see, you become a US developer and that's what you do. So, look, I think that's part of what we've developed real expertise in is focusing in where we are focused, right? For this audience is we believe not only just the highest growth, but also highest value power markets that, not coincidentally, are right on the bleeding edge of energy transition. There are certain diseconomies of scale. You're probably right. There's also massive IP creation from things such as, things we see in certain markets that we can then use in other markets that are perhaps don't even exist, whether it's a hedge structure, for example, that we're using in the UK that we can now use in Australia, or, for example, settings on a grid forming inverter, some esoteric technical specification that we're seeing live in Australia, right on the bleeding edge, that we're using now into the design of our large-scale battery storage assets in the UK. But I would also disagree, right? We're looking to build large pools of risk in any of these markets. What we're not doing is building one project, two projects in a single market, right? In the markets we operate, right? And just quickly, that's US. In Europe, we've got a big commitment to Europe, so that's UK, Spain, Italy, Poland, and Germany. We've got businesses in India, Japan, and Australia. That is it, right? We're not going broader than that. They're all OECD. I mean, India is probably the one singular exception, a bit more cuspy from a credit perspective. We've actually, given our lack of rupee-denominated risk, have actually sold down that position, the majority of that position, to CIP recently, actually. Mm-hmm. But the rest of these businesses are that businesses, right? They're not a sort of odd selection of portfolios of projects, right? These have management teams on the ground, 20 to 50 people, depending on the location. And we've done that from literally de novo scratch, right? We don't typically have development partners in many of these markets, right? We're literally going into a market cold. But having, been doing this for 25 years, I think we're now pretty good at doing that and identifying sort of how you build portfolios of risk, and obviously have a pretty long track record of doing that now and delivering businesses, not frankly platforms in these markets, not just portfolios of projects. Yeah. And it's obviously it's scaled over time. We're continuing to drive bigger scale in any of these markets. For example, our UK battery portfolio, we've been there only 2 years, but we are intending to build 2.5 gigs on the downside of standalone battery storage. We've already got 3 transmission connected assets in the portfolio, each of them 400 megs, 2 hours of duration, and have already got the team assembling around that. And as a result, there's a ton of very specific expertise and IP that gets funneled in from around the world to enable a business like that. But there's also a ton of IP that we are also building in country, and now arguably have one of the most attractive and largest platforms in that market, with attracting a lot of interest from both investors and strategic. So I think I wouldn't say there's tremendous diseconomies. I think it's actually the other way around right now, given sort of our scale. Yeah, there's actually massive synergies across the.
But it requires you to go a bit deep into those markets as well.
So what that requires is a ton of my time and my partner Dave Rogers' time to be very actively involved. And even though we have senior management teams in each of those markets, we don't just cede control to these guys and sort of check in once a month. And this is very, very actively and closely managed, which, given the time zone vagaries, makes for a lot of late nights and also a lot of miles on planes, right?
I think that point about pattern recognition and taking learnings from one market to another on whatever, hedging structure or whatever it is. I mean, it is one of the, at least in my experience at Aurora, it is one of the free lunches in the energy transition, in the sense that, all the problems are the same, exactly. The same archetype in different ways. It's just the terminology is different. But I entirely agree. Good. How does the other bit here is, how does AmpX, so this sort of technology part of the business, fit together with being an investor? Again, it's unusual, right? People get good at developing, operating, maintaining assets. They tend not to then focus on something like software. So why does this make sense to you?
Yeah. Well, we're not in the business of software, nor are we in the business of hardware, right? We're in the business of delivering certain attributes from a power systems perspective, right? So when we started the business, 13 years ago, it was a very, very discrete focus on delivering large pools of risk. So, a real assets business. And that, back then, as you know, John, with $350, $400 billion of annual investment, that's not new. That's probably 20 years of history at this point. So that was the bulk of the focus. Now, having said that, we also had to recognize back when we started the business, that as you started putting on renewables in an individual market, for the first probably 8 to 10% of net generation coming from renewables, there was really little impact to the grid. But we also had a view that once you started going much past that, there was a very non-linear impact, and by the sort of the unintended consequence of introducing this variable supply that caused problems around frequency and voltage specifically. And now with electric vehicles, now it's power factor is the next problem that's been introduced. How do you keep that constant? And so we had a view that, and as you started rushing to net zero, by the way, right, this non-linear impact from, call it 10% to 100% was frankly, the market was essentially net short inertia. So we had a view that there would be increasing value migration, actually, not just net size of the market would increase in and around provision of flexibility, but we actually saw there'd be a migration of value away from the commodity of generation, generation being essentially short gamma. So we had that view that flex was going to be really interesting. Now, 13 years ago when we started the business, there was really no way to sort of express the view. We were obviously earlier in penetration in many of these markets on net contribution from renewables to begin with, but there also wasn't the technical solutions, and battery storage as a piece of that puzzle was also obviously out of the money. So we didn't do anything really until about 3 years ago when we started AmpX, and it was really the advent of it was quite simply we were starting to add large scale battery storage to our fleet. Maybe it's just coming from a trading background, but we still view that there's too much alpha in that dispatch decision to sort of hand it off to a third party. So we always had a view that was something we were going to own ourselves. So we started doing that when we run about 200 megawatt hours of our own storage assets today in the US, all controlled by this dispatch capability, this optimizer capability, if you will. It's, how do you do that? You obviously need a bunch of data scientists creating pricing heuristics and surround them with a bunch of software guys. So that was the initial genesis. It was really a utility that was to provision our own assets. And that was with a view to sort of global, provisioning of assets. It wasn't really intended as a commercial product for third parties. Now, once we did that, then we sort of figured out, and it was probably, we've got a couple or a handful of probably some of the world's best sort of engineers specifically focused on sort of grid edge. And they also have a really interesting view from a control systems perspective, because we sort of viewed that, look, and they're based in the UK, by the way, right? And as the market moved to sort of this sort of mass distributed sort of grid edge, topology, we there was no shortage of assets that could actually provide and provision some of these flexibility services. The problem was there was just no way to actually control them. So it's actually, from our perspective, it became quickly a control systems problem. Now we had a view on how you could actually solve that, which was not through automation, which is sort of where most people are focused. It's certainly never been done in the energy space, but we actually sort of sought an answer in basically delivering a fully autonomous distributed control architecture. Again, that's not from within the energy industry. We actually went to the defense world, where there's been a massive investment in basically developing distributed missile systems. And we have basically ported some of those, a couple of the lead aerospace engineers into AmpX to basically develop that underlying architecture. Now, that all is now operating. So we can now basically provision N devices behind the meter and dynamically shape load. We've won a whole bunch of innovation awards in the UK. This system is live and running now with customers in the UK. So as a piece of the provisioning of dynamic grid edge flexibility, we're already up and running. And last but not least, because I know you referenced this transformer, there's a device that is a replacement for a transformer that we've also developed, a small piece of grid hardware that is going live right now with a very large DNO in the UK. Confidential at this point as to what I can say, but watch this space, that there will be public announcements on this in the next few months. This is a very disruptive technology, all part of the same platform. But if you really think about what we're developing, it's not, yes, there's a bunch of technical solutions that we've managed to deliver in a pretty short amount of time, but it is fairly disruptive in what we can now actually deliver to the grid operator, which is we basically provide an ability for them to dynamically provision flex at grid edge from grid edge assets that otherwise doesn't exist. So, if you think about what we have, right, we've got a whole portfolio of very large scale in front of the meter assets that we're looking to develop around the world. Big focus on storage, and then now with a sort of the counterfactual, if you will, of now enabling the operators who are really our customers to deliver grid edge flex from distribution connected assets.
Yeah, is there just one thing on you're endeavoring to innovate at the distribution level? I suppose a simple way to ask this question is: does the existence of monopoly, DNOs inhibit, and monopoly network owners inhibit innovation, do you think, in your experience?
I think they have, perhaps historically, but I think that's all being opened up now with the DNOs now being forced under 83 to basically create a DSO, right? Yeah. So you're getting sort of division of separation of church and state. Yeah, so we're actively involved in that process on how you split up various different services, how that's procured, who pays for what's a regulated asset that is still owned by the DNO, and how does the DSO actually split off other services that it could potentially source from some of the same assets, but also source from other market structures.
And so implicitly, you think the British example may well be the one that gets aspects of it will be exported to the rest of the world. I mean, is the UK leading the way on this?
Yeah, the UK, look, it's certainly some of the DNOs are seen as global leaders in innovation. But having said that, you've got a number of the different DNOs from around the world watching very closely as they're sort of unbundling some of these services, looking to provision cost-effective grid edge flex. Australia, I would probably add is someone else who's sort of focused significantly on this, and they're looking at various different sort of configurations of our products to deliver a similar but actually quite different service. So one of the additional technology overlays that they're looking to roll out, which is quite intriguing from a topology perspective, is actually we have the ability to DC couple this thing we call a smart transformer, this pretty innovative piece of grid edge hardware. We can DC couple that to a battery. So some of the DNSPs in Australia are actually looking at deploying fleets of these assets, right? So if you think of now having a dynamic, resolution of voltage instability at grid edge, we can solve for, we can keep power factor constant as they roll out EVs. So that's the primary function of this smart transformer. It also does other things such as provision inertia from the distribution substation, which is obviously pretty innovative. So we can do that sort of dynamically. But if you now then couple that to a battery, where the grid is, in the Australian context, they're calling it a community battery, right, where you have the network operator owning a fleet of distributed battery assets sprinkled through the network, which is really interesting, right? What's the role of a battery? Is that a network asset providing some wholesale services, or is it a wholesale asset providing some network services?
Yeah. Yeah. Well, I will get into market design in a sec. In the northeast of the US, I think they call it virtual transmission. It's a similar sort of concept of regulated asset-based batteries as a substitute for copper. So we'll dig into that a bit later. Just one other question on that VPP piece. What does this may be very simple, but what is the motivation for someone who owns an asset, whatever it is, a solar panel on their roof or whatever it is, to use your software? Is it about making money in general?
Yeah, so we don't sell to consumers, just for perhaps clarity, but we are engaged. In fact, we're executing a contract right now with a fairly sizable retailer, actually, who's looking to deploy large scale for their customers, large scale batteries and solar behind the meter, obviously. And so again, the value prop for them, quite simple, right, is to obviously have Ampex be the management platform for this. But then, obviously, have the operator or the retailer offer some of those network support services into the other market constructs, which are being developed sort of real time. Yeah.
Is there I'm not sure we talked about EVs yet.
Yeah.
Is there, because to me, from a storage perspective, there's obviously, if you do the maths, I've got an EV, I think it's 81 kilowatt hours or something of storage. So once you get millions of these things, you've got infinity storage from a grid perspective. It feels like is part of your vision here that EVs are also playing a role. And I suppose the natural question then is, how do you see the competition between large scale storage, grid connected storage, and this massive battery in our vehicle fleet?
Yeah, look, I think theoretically, electric vehicles or distributed fleets of electric vehicles rolling up through, V2G is obviously highly interesting. Through our platform and some of the work we've been doing with this UK Energy Catapult recently in the UK, we've actually demonstrated this autonomous control architecture. So literally, you plug the EV into your charger. The decision making to charge and discharge, whether that's once or many times, is actually that decision making happens on the car, right? So it's completely independent of your input. Obviously, it operates within constraints, right, including warranty compliance, for example. Obviously, it needs to be informed as to when you do this through AI, as to your usage patterns and when you need a full charge, for example. But the optimality and the optimization of that charging and discharging pattern is all done fully autonomously in the background, which is obviously fairly disruptive. That exists today, but we're not aware of anyone else who can do that today. Mm-hmm. So is there a role for all of that? Yeah, I think there is. I think that do they compete against, like, for example, our large batteries that we're building in Scotland? I mean, I guess on the margin they may with critical mass. So is that 10 years out? Yeah, perhaps. We also provide some pretty critical, grid support infrastructure. I mean, these are essentially gas peaking de facto assets, what we're building in Scotland, right? They do some other very, mission critical and provide some mission critical support, including Black Start that we're exploring literally as we speak, that I don't think we're ever going to get the benefit of, distributed sort of rolled up, vehicle fleets. I think, but there's clearly a role, right? And I think that's not just across EV fleets, but obviously, larger power system, mobile systems such as, school buses, for example. There's been a lot of discussion and chatter and, exploration of different models around those fleets, which are obviously not just high power rating, but also relatively underutilized. So that's obviously interesting. So I think you're right. I think they do play a role. I think the question will be what and how significant a role it is. I don't see there being a threat to any sort of large scale in front of the meter assets anytime soon. Yeah. Maybe sort of next stage, right? Maybe call that plus 10 years out. That may be a whole different story.
Yeah, interesting. Okay. And just one other piece of the AMP story. I know you've been spending a lot of time in the green hydrogen space, reasonably recent thing. What have you been up to? And I suppose the more specific question is, at what... I look at it from a power sector perspective mainly, but is there at what point do you think lithium-ion stops being a cost-effective storage solution, and do we have to start thinking about things like green hydrogen or CCUS or hydro, pumped hydro, or those types of things?
Yeah, it's a really interesting question. So we've been involved with developing green hydrogen sites for probably now 2.5 years, and it started initially in Australia as we started seeing. And look, I come from a background of structured commodity risk. I was probably more skeptical than most. We started seeing guys running around with not even business plans. They were PowerPoint presentations on hydrogen this and hydrogen that. We were not convinced. What we did do though, when we started seeing enough of these guys, was to basically do a sort of a big fundamental sort of ground up analysis, not focused on Australia, actually, but looking at globally, like where do we think we're going to see sort of emerging LCOH, and who's going to win that race out of the gates. Interestingly enough, Australia is one of the perhaps winners, certainly one of the early players, as are there a number of countries in Europe and the Middle East, and then one or two in Latin America. So hydrogen for us is a pretty logical add-on to some of the projects that we are developing, not all of them. But so as a result, in the last 2 years, when we sort of focus this as a sort of discrete business capability, right, we've got now 4 locations globally that we are, rapidly developing. And I think, we're not just doing that in a vacuum, right? We are now fully engaged in whether it's North Asian interest, which has been surprisingly more robust than we'd thought, but frankly also seeing a lot of interest out of Europe for perhaps obvious reasons. And there was interest pre the Ukrainian situation. That's obviously become way more robust even since then. We had as you'd expect, probably given the background, we developed also a pretty comprehensive financial model informed by one of the best engineering firms in the world on in this space. Probably viewed this as being in the money in 26, 27, right? Was probably which is not too far off, obviously. But, obviously, again, with what's happened in Ukraine, right, this is in the money now, right, with prevailing gas prices in many markets, and sort of what we're seeing in specifically green ammonia is probably the export product. So, yeah, this is getting a lot more traction, a lot more quickly than we would have expected. I think there's a couple of strands to your question, right? So I don't see this displacing lithium anytime soon. I think this is going to be a massive portfolio effect, right? That we're going to need as much lithium, we're going to need as much hydrogen. It's all going to play a role over time. Yeah, could you see that changing? Of course, but again, there's a lot of transition, quote unquote, that needs to happen here. Every probably source and flexible source has a role. And yes, clearly there's going to be very different price points, and obviously a ton more lithium capacity coming online, which will change the economics too. So I don't think it's quite as elegant as one works today, the other one works tomorrow. It's going to be, all of it needs to be part of the supply at the end of the day.
Would your enthusiasm for green hydrogen decline if net zero weren't the target? Let's just say we were looking at 90 or 80% decarbonisation. Does that change the relevance materially, do you think?
Good question. So here's the anecdote that's probably similar, right? Is you would think, right, in this commodity environment, right, this price environment, you would think the focus on green hydrogen may even, certainly from the oil and gas majors, right, and sort of which is the other piece of this, you would think their focus on anything green would probably go away, right? You think it would be completely focused on thermal, completely back to their core, and continue to see massive cash flow, accretion to their core business with zero additional cost, right? Which is what you're seeing. Yeah, like numbers you've never seen before. So if they could print a few more years of that, you would think the whole green, energy transition would be put on hold. That's not the case, right? From conversations we're in the middle of right now with a couple of these guys globally, their focus is now even perhaps more resolute. They just said that the appetite for going to committee on a thermal asset is, yes, it's there, but quickly the conversations changes to where is the corresponding sort of offset, if you will, in our business, right? We need, some additional renewable generation or storage, or obviously now the move to fuels. So, I don't see this changing. Just going from 100% to 90%. Does that move the needle? I'm not sure it really does, to be honest. This is so quickly, left the station, and you're seeing countries move to these types of alternative fuels for so many different reasons, right? Whether it's, the Koreans or the Japanese looking to co-fire with coal, whether you're looking at bunkering sort of alternatives with, whether it's methanol or ammonia. I mean, this is happening in large scale now, and sort of procurement discussions. And we're not talking about, sort of small trials now. We're sort of talking about large scale procurement.
Interesting. And just on the green ammonium use case, is it, you mentioned a couple there, bunker fuels, you mentioned coal as sort of coal substitute. I know Japan is looking at burning ammonia. Yeah, is that, what are they the use cases, or what do you see as the number 1 and 2 use cases here, 5 years hence?
I think both of those are, right? So I mean, I don't think it's hard to call winners at this stage. They're clearly two of them.
Yeah.
I think the import play into continental Europe is fairly profound. Is that for use in petrochemical industries to displace thermal? Is it for ultimately, and the technology is not there, but from what I can hear, what people tell me is it's getting close, is cracking ammonia back into hydrogen for dual use. I think it's probably all of the above. Is it taking, so for example, one of our sites in Europe, we would be looking to put hydrogen into a pipeline system. So is that for use in a dual fuel combined cycle gas turbine, right? They're all dual fuel enabled. Certainly the new fleets are. So I think it's a mixture of all of the above, but the volumes are staggering, right? I mean, you don't need particular, large demand coming from any customers to basically underwrite a gigawatt facility, right? I mean, we've got certain customers we're in discussions with right now. They're not tier one customers, right? These are names that aren't necessarily on the front page, or certainly top of mind for most investors probably. And they're looking for anything from a gigawatt of energy equivalent demand in, call it 26, 27, 28. But that quickly becomes a single customer. That becomes 10 to 12 gigs in the next 3, 4, 5 years beyond that.
Yeah.
And the power implications are non-trivial, right? And so I think this will be a classic hurry up and wait sort of market until all of a sudden overnight this is zero capacity, right?
Yeah. Well, I mean, that's certainly the Aurora experience. I mean, there's tens of billions of public money and tens of billions at least of private money that's been raised over the last couple of years. So it's going to result in, and it's a proven technology, so that's going to result in something. And I mean, in our own case, the enthusiasm to know more about hydrogen and the enthusiasm to understand economics has been remarkable. So I don't disagree. Can we move? It'd be good to talk a bit about sort of moving beyond AMP's activities to the industry more generally. One thing we talked about was, I suppose, pattern recognition across markets and the challenge of operating in a few different challenges and fundamentally benefits of operating in many jurisdictions. What's the best market design you've seen for enabling batteries to provide all of the different benefits you've talked about? You talked about black start, you talked about congestion management. What's the best one you've seen?
I think perhaps the most interesting from an investment perspective is something like the UK, right, where you've got complete unbundling of services, which I think is obviously intriguing, the ability to revenue stack every which way. That's interesting. I think, certainly where we're located, right, which is in Scotland, it's probably the most constrained area, or it is the most constrained area of the country, and they're about the entire country is about to put on another 25 gigs of offshore wind licenses just recently. That's all going to be built, obviously, north of Scotland, which is and needs to get down to the load pocket of London across some very constrained interconnectors, right? So they're exploring various different inertial market constructs in what they call Pathfinder. There was a stability Pathfinder and a constraint Pathfinder, essentially de facto auctions for inertia, but very locationally specific. But they're obviously National Grid, for example, is currently provisioning, I think the order of magnitude is about £4.5 billion of essentially balancing mechanism, which is de facto how do they balance at that point of constraint. Yeah, that's expected to double, right? And so the fact that they've been able to disaggregate locationally near constraints, I think is obviously pretty smart from a market mechanism. This is the lead offender in the country, so they're clearly throwing a lot of different types of market constructs added in order to lower costs for customers. You don't see that as elegantly in most markets, right? It's a bit more of a brute force approach.
And do you think it ultimately leads to a nodal price? You talked about sort of balancing, and in a sense, that's kind of socializing the redispatch. It's you don't quite see the nodal price. Is the end game here the most elegant solution that it moves nodal?
That's right. It has to. Yeah. I mean, that's obviously in discussion, and some of the machinery that's required to deliver that is in the makings. We understand. So that's, I think, where it goes.
Yeah, I totally agree with you, Paul. I don't see how you resolve this.
That's right.
In a control, in a control, the guy dispatching in a control room in Wokingham, as effective as the people in the control room in Wokingham are. This is very complicated. Yeah, entirely.
Yeah.
Do you? I'm going to ask you an impossible question. Maybe you've got an answer to it. What percentage, if copper has been 100% of the answer to congestion in power markets over the last century, what percentage of that do you think batteries can displace?
Yeah, obviously that's a hard one to give
the
real answer. But yeah, look,
is it material? Is it trivial? Is it?
I think it's meaningful, but again, it's not a single source answer, right? It's going to be multiple threads of value that the operators are looking for, and they're doing that now, right? And certainly as they unbundle DNO and DSO, so they're looking to have these local sort of market constructs where they can basically bid out various constraints. Looking for market mechanisms to solve for that. And I think one of the DNOs is looking to solve under this ED process. What is it? I think it's 450 million pounds of constraints that they're going to spend basically, 8 million pounds on, right? So there's a nice little NWA sort of alternative, if you will. That's nothing to do with batteries. Is batteries a piece, an adjunct to that sort of market-based strategy? You betcha. That's clearly where it's all going, right? And I think that's also what AmpX enables, an operator to deliver is a massively flexible system using all available resources without, investment in underlying infrastructure beyond, obviously beyond the original AmpX spend. That's clearly where it's all going.
Yeah. Okay. Yeah. And the other bit is, we didn't talk about it, just the near impossibility of building high voltage transmission lines in sort of democracies nowadays. I think all of the Scottish congestion management has been north south, but in the water, sort of within a country, but in the water seems to be the way they do it. And obviously Germany doesn't have enough water on the east or west of the country to go from north to south. So it's just paying up for redispatch, really.
Yeah, and the timelines associated with it, the environmental issues associated with it. Yeah, it's just those days are well and truly past, right? I mean, I think Ofgem's been pretty clear, certainly in the UK construct of this has to be quick, and it has to be how do you drive savings for consumers, and I think that's been true for a number of years with Ofgem. It's obviously even more of a prescient sort of political point right now with what's going on with power pricing.
Yeah. Yeah. Just one other thing I wanted to pick up about the industry. You talked about a philosophy that there was too much alpha in trading the assets yourself to leave it to someone else.
Yeah.
So I'll give you a couple of options and maybe it's someone else, but who do you see as the natural party to optimize battery revenue and just control the thing in general? Is it? I mean, your route at the moment, and I suppose I'm asking 5 or 10 years from now, when the industry may have commoditized and separated a bit more, is it still going to be asset owners who have maximum skin in the game? Is it going to be a sort of trading teams like we see now for a lot of assets, where it's an EDF or a Statkraft who's got a big trading floor, has a balance sheet? Is it the software companies, the Fluence AMS, is it sort of the route to market optimizers, Habitat, that sort of thing?
Yeah.
Or is it, is it OEMs, I suppose? Tesla do their thing, Fluence do now have AMS, which they acquired. What does this look like? I think
it's a great question. I think the answer though is actually quite simple from a trading perspective. It's not just algo, and we're not trying to suppose it is, by the way. So although AmpX has a full algorithmic trading capabilities, that we believe goes head to toe with, or toe to toe with any of the guys, AutoBidder, for example, or Habitat, we also believe strongly that it has to be, certainly when you're dispatching large scale assets, that you need to pair it with a physical trader. So whether that's our own trader, whether that's we partner with a Habitat, whether we partner with an EDF, just to use an example, all of those examples work. But that's best execution. I think what will also drive it, right? It's not just an arbitrary us selecting best execution, which one would hope that would be the case, but there's also sometimes constraints that are introduced by some of the hedge constructs or hedge contracts, I should say.
Yeah.
So some of the the contracts we're exploring right now around our assets in the UK, by definition, will require the third party to provide some of those optimization services, but even then, the devil's in the detail, right? So having the ability or capability we're already going to interpose basically a parallel dispatch or a shadow dispatch capability right on top of it, which, if nothing more, will enforce, a full audit trail, right? Because otherwise, there is no ability to audit what EDF is going to give you, right? You're going to send you a check at the end of the month. So that's somewhat fundamental, but it's also about driving optimal outcomes, right? And so to benchmark ourselves against them or benchmark them against us is obviously everything at the end of the day. So this is all about QA.
Yeah. So could you see yourself dispatching other people's assets as well?
Yeah, we are already. Yeah, and we've had a lot of interest. Ironically, some interest from some of the incumbents who have big platforms in-house have come to us looking to partner.
Interesting.
Which I think is interesting. Yeah.
Okay. Yeah. It's a very interesting space. Excellent. So before we conclude, I'd like to ask you about a couple of concepts in the energy transition and ask you if you think they're overrated or underrated by the practitioners, I suppose, rather than the general public. So let me start with. So at the moment, a big issue is duration of current disruption in supply chains for solar, especially in the US, and storage, particularly around availability and pricing of metals. Do you think the duration of that disruption is overrated or underrated at the moment?
The solar in the US is obviously, that's a real issue, right? And I mean, it's an issue, but it's a political issue, right? In of itself, right? So it's actually quite easy to solve, but it's a much broader geopolitical trade issue, right? That's nothing to do with the underlying supply chain on storage is a completely different story. On storage, this is short term. There's nothing. We're in the middle of procuring. At the moment, the front end of two batteries, and the third's about to happen. So 1,600 megawatt hours out of the gate. So one of the largest battery procurements on the happening at the moment anywhere. We haven't seen. So there's been some slight price elevation. Obviously, lithium has done a nice run, 6x or whatever it is in the last 6 months. So obviously, that's all very transparent. Lithium's a relatively small component of total system cost. So that's the first piece I would add. I think the other thing is where people are getting burnt is I think many developers have been carrying costs or projected cost of deployment at, in the old world of traditional development, right? Which is if you're going to build this in 2 years' time, you therefore expect a declining cost curve and they carry in your model, your cost less, whatever it is, 10%, 20%. So I think for those guys that's been the somewhat standard industry practice, especially if you're getting into auctions. For those guys, they're getting stung, right? Because obviously they're seeing meaningful price increases. We were not doing that. We were taking a fairly conservative approach. So, yes, there's been some slight increase in costs. It hasn't really, frankly, changed the unit economics. And that's obviously on the cost side, right? There's obviously been a pretty dramatic change on the revenue side of the picture as well. And as far as like availability of supply, there's no shortage of availability of supply at all, right? It's the constraint has been around lithium. Lithium is not a rare metal or a rare compound. There's a timing mismatch between the deployment of, there's announcements every day, as everyone knows, on, a new gigafactory here, a new gigafactory there. There's a fundamental timing mismatch, right? It takes you a couple of years to build a gigafactory. It takes you probably 5 years to get a new lithium mine up and running. There's a decent amount of new supply coming on this year.
So that's to say 3 years from now, you think the cost of the capex of a battery will be lower than it was last year, and Correct. The availability won't be a major issue.
Availability is not an issue. It's more there's a short term. There's obviously some monopolistic behavior going on by some large. The supply chain is controlled by one very large player right now.
Yeah,
that's in the process of changing pretty quickly. So yes, for the next 12 months there will be some potential dislocation as there's some monopolistic behavior going on. That's about to change obviously as new supply coming out of Europe, for example. There's a number of new players that are going to diversify away from this big Chinese entity.
Yeah. Okay. Interesting. So the second concept, investment risks associated with merchant battery business models. Do you think they're overrated or underrated?
No, they're very real. Very real. I mean, we're not. Even though we come from a trading background, we're still looking to have some sort of structured hedge in place on everything we do. We're looking to have some, basically a structured call option, right, with some nice exposure, some nice convexity at the end of the day, the way we're looking to structure this. But we're not looking to take naked merchant risk. That's a really dangerous game, I think. Certainly for most folks, and that's, we certainly wouldn't do that.
Okay. And so who should bear that risk then?
Well, again, this is back to fleet approach, right? So it's the large guys who've got very large fleets of assets and got various different exposure, whether it's a big market incumbent like a Shell, for example, in the UK, or an EDF, Statkraft. I mean, guys like that who have a book of risk, and this is just a piece of offsetting a piece of that exposure. They're the logical guys to wrap their head around it.
Yeah. Okay. Got it. That's helpful. Final concept, the need, and we touched on this a little bit before, the need for new network, and by that I mean high voltage transmission network, to enable a net zero power system. So, you know, I think everyone agrees we need more network, but do you think the amount of new network needed is overrated or underrated?
It depends a little bit. So I think you certainly need more. But here's the AEMO numbers, which you're obviously very familiar with, I think, and I'm going to probably get the numbers wrong, but just order of magnitude right. You know, and in a hydrogen case, right? And for most listeners, I suspect people will get a sense for this, but if Australia was to become a hydrogen, superpower, which is an aspiration, but, let's just use this number as a bookend, AEMO's analysis, right, is that you need probably 40 times the current generation capacity of the country, 40. What does that mean, right? You obviously don't have the grid capacity for that. So yeah, you're going to need to upgrade a meaningful amount. But here's also what goes with that. Much of that will probably be behind the meter, right? So if you believe hydrogen is enabling a big chunk of the remaining, carbon-heavy industry, well, you're going to need to build out very large-scale, hydrogen, and as a result, some meaningful transmission. But some of that will be behind the meter, right? Is the other acknowledgement. So yes, we're going to need more, but it's probably but.
That's a very good note to finish on. So thanks so much for spending the time to talk through all of the fascinating things that you're doing right now at AMP, Paul.
Thanks, John. Really appreciate the invitation to spend some time with you.
That was John Feddersen, founder and chief executive of Aurora, talking to Paul Ezekiel, founder, chair and chief investment officer of AMP. Do keep an eye on our podcast feed for more in-depth conversations with senior members of the energy industry. The best way to do this is to subscribe on whatever platform you use. Thanks for listening and goodbye.